running your machines, making the actual product, it goes right into WIP. If labor is untraceable but necessary for production, the cost of your custodians, the cost of administrative oversight, supervisory oversight within your company, that doesn't get traced. That has to go where all non-traceable indirect costs go, which is your manufacturing overhead pool. So in this case, if during 2020 Smart Touch Learning incurred total labor costs of $197,000, of which $169,000 is direct labor and $28,000 is indirect labor, well, that direct portion gets debited to WIP. So we would debit WIP inventory for $169,000. The indirect portion gets debited to manufacturing overhead, so we would debit manufacturing overhead for $28,000. And in total, there's $197,000 of labor costs. Let's assume that we've not yet paid our employees yet, and we're going to credit our account wages payable. If you had paid them in cash, your credit would be to cash. So again, your credit in this entry is always the payment method. So we have direct materials, we have direct labor, we have a methodology of tracing them to the job cost records, and we know now how to record them in our journals when that happens. Well, what about the third cost component, which is your overhead costs? When you have actual overhead costs, you need to add those to the pool. You need to put those costs in the pool because that's the amount that you have to spread out amongst all of the different jobs that you're doing. So Smart Touch Learning here had depreciation on their manufacturing plant and equipment. There's no good way to trace how much value a piece of equipment has lost, making in this case job 27 versus job 28, 29, etc. So that $20,000 of that needs to go into the pool. They paid plant utilities in cash of $7,000. Again, no one's going to go sit and track how much electricity was used up by a particular machine during the period while it was in use for a particular job. It's just too much work. That goes into the pool. They had prepaid plant insurance of $6,000, which expired. Again, that's a necessary cost of production. You're not going to keep employees at your place long if you're not offering any kind of insurance in case there's an accident. So that has to go into the pool, but there's no good way to trace, how much of that insurance should be relegated to each particular job. And plant property taxes. If you don't pay your taxes, they're going to take the plant away from you. That's a necessary cost of production. You can't trace it to job, so it goes into your manufacturing overhead pool. And the rule of thumb with the manufacturing overhead account here is when something is an actual real cost, it gets debited, which we've done already, right? Indirect materials, that's still a very real cost. We had to pay for those glues and rivets and, in this case, we had glue for the binding. We had all sorts of other stuff that's a very real cost. Indirect labor, we have to pay our custodial staff and our security. That's a very real cost. And these were real costs. So anytime you have an actual cost happen, in the journals, it's always going to be a debit to manufacturing overhead. The credit is to the reason. So what three things did we have here? Four things, excuse me. We had depreciation of manufacturing plant and equipment. What would be the credit for that then? Accumulated depreciation. The next thing we had is plant utilities of $7,000, which were paid in cash. What would the credit be there? It would be to cash because we had to actually physically pay this. We got to reduce our cash account. Why don't you debit utilities expense here? Because this cost, since it's the utilities for the manufacturing plant, is a product cost, and therefore it's inventoriable. You would put it into the cost of the particular products that you're making instead of expensing it at the time. But since it's not traceable, it's going to take its first stop in this manufacturing overhead pool. We had the expiration of prepaid plant insurance. That's why the credit in transaction 6 is a $6,000 credit to prepaid insurance. And then we received a bill, which has not yet been paid, for $5,000 for property taxes. Well, we know we owe it, so we got to put it on the books. We haven't paid it yet. We're going to call that account property taxes payable. Problem with that, waiting around for actual costs to put them in the job, is what happens if you finish a job and you sell it and you need to record cost of goods sold before you know what the actual cost was, like a utility bill. You're not going to know exactly what it is till the end of the period, until say the end of March. But what if the job is done being produced in the middle of March? You need to transfer from WIP into finished goods. Now you don't have an actual cost. So what companies do is a process called allocation, and in simplest terms, it is your best guess. It is your best guess at how much overhead you should be putting into jobs during the period. And how companies do this is they figure out some aspect of the business which causes the majority of these overhead costs to be incurred. If you're running a very machine intensive operation, maybe it's the number of machine hours that go into each job. Maybe it is the number of direct labor hours that go into each job. Maybe it's the direct labor cost. But you find something within production to use as your basis for spreading out all of these indirect costs that we've been pooling. And that thing in accounting terms is called the allocation base, but I like the term cost driver better. It's the thing that drives up all of your indirect costs in here. And to spread it out, what they do is they take their best guess at what total overhead costs are going to be at the beginning of the period. They determine that driver, and they need to figure out how much of that cost driver they're going to use during the period. And then you divide your total estimated overhead cost by the total estimated quantity of the overhead allocation base, or your cost driver, to come up with your predetermined overhead allocation rate. Again, which thing you use as a driver, there's no rule set in stone. This is managerial accounting. We are up to our own devices for how we're going to spread this out. We just need to figure out what is our most important cost of production. So it could be direct labor hours if it's a labor intensive thing, or you could choose to use costs if it's a labor intensive thing. If it's machine intensive, maybe it's going to be machine hours run on each particular job. Find that vital component of production, use it as your driver to spread out all of these pooled costs into the individual jobs. So in this case, Smart Touch Learning has decided to use direct labor costs as their driver. They're saying the more time the employees work on jobs, the more costs it's going to cause them to incur, both for direct labor and in this case in overhead costs. So they estimated their total overhead costs for the period is going to be $68,000, and they also estimated their total labor costs for the period were going to be $170,000. Well, if you take $68,000 and divide it by $170,000, you get 40%, which means what we're saying here is that the overhead costs that are going to be incurred is always going to be equal to 40% of our labor costs for that particular job. Or for every dollar we spend on labor, if you want to think about it this way, we should allocate 40 cents of overhead from that pool into the job. So on job 27 that we are keeping track of in our job cost record, let's go and assume that the total direct labor cost for the job was $1,250. Well, we're using direct labor costs as our driver. So we need some kind of rate. We just determined that was 40%. If we're saying that each and every job we do, the overhead costs it causes to incur are going to be equal to 40% of the direct labor costs that we pay. Well, job 27 had $1,250 of direct labor costs, and 40% of that is $500. So now we know all of the different cost components. We had $2,750 in traceable direct material for job 27. We had $1,250 of traceable direct labor for job 27. And then job 27 took part in making us incur costs which are not traceable. And we've decided through this method we came up with to assign $500 of those indirect costs to this particular job, job 27. When you add those three together, 2,750 plus 1,250 plus 500 is 4,500. So what we're saying here is that job 27 is going to cost Smart Touch Learning $4,500 in total to produce. And since they're making 15 tablets, each tablet is going to cost $300. And in its finished glory, here is our job cost record. Every time that Smart Touch requisitioned materials here, it went into the direct materials column on this particular job cost record. They had 3 requisitions. The first one was for $825, which we already recorded. And there's another one for $650 and one for $1,275. For direct labor, the first labor time record number recorded was for $90. They had 2 more, which was $450 and $710. And then we used this to direct labor cost to allocate out cost from our manufacturing overhead pool to the jobs. And for job 27, that cost was $500, bringing us to a total cost of $4,500 and a unit cost of $300. This is in your system as reference. Every time you want to go back and figure out what a job costs, if you're predicting the cost of future jobs, you have something as a point of reference. And if you're keeping track of your books, well, this is where you're going to figure out what cost you're assuming each job is costing you. So our methodology here is to always assign overhead to jobs equal to a portion of the direct labor costs. Well, since we're assigning it to jobs, we need to be increasing the costs, the inventoriable costs within our inventory as we are incurring them, and as production is going on. So work in process inventory as an asset goes up on the debit side. We need to allocate out overhead from our pool to the jobs. And in total, not just for job 27, but all the Smart Touch Learning jobs, they came up with $169,000 worth of labor costs during the year. That's how much they pay their employees in total. Well, if we're allocating out costs from the pool at 40% of direct labor costs, 40% of 169,000 is 67,600. So since it's going into the jobs, the debit has to be to work in process inventory, and the credit in this case is going to be manufacturing overhead. And that is the rule of thumb with your manufacturing overhead account. If it is an actual cost that was incurred, it's always a debit. And as you can see in the T account in the bottom left hand corner, those were all of the actual costs we had: direct materials, direct labor, depreciation, property taxes, prepaid insurance, rent. All of those things were actual costs that we incurred. When you allocate from the pool into a job, that's when you credit. So actual debit side costs go into the pool on the debit side, and then allocated coming out of the pool happens on the credit side, which is why we credit manufacturing overhead in this journal entry. So what happens now that we have all of our costs into this job cost record? What happens when the job is finished? And furthermore, what happens when we actually sell that job? Well, we have to keep a series of journal entries to keep track of that cost flow of inventory. And the first one is to transfer all of those costs that were on our job cost records that we're keeping track of that went through out of WIP, because it's no longer a work in process, and into finished goods inventory once that job is completed. And the entry for that is always a debit to finished goods inventory and a credit to WIP inventory. Again, all inventory accounts are assets. Assets go up on the debit side, which is why finished goods has to go up now, because we have more jobs that are finished. And then inventory accounts always go down on the credit side, which is why we're crediting WIP, because those jobs are no longer a work in process. We need to reduce that balance. What happens when you actually sell in this case? Well, during 2020, let's assume that Smart Touch Learning sold jobs for $1.2 million, and those jobs cost them $584,600 to produce. No matter what type of company you are, as long as you're dealing with inventory, every sale is always going to require two entries. The first records the revenues, and the debit is always to how you're paid, and the credit is always to sales revenue. So in this case, let's assume we're being paid on an account. We're going to debit accounts receivable and credit sales revenue for the sale price. We sold these for $1.2 million. The second entry always records your expense. We've been keeping track of all of these costs, and we've been adding them to the value of our inventory, increasing the value of that asset, because we don't get to expense them until we actually sell the product. Well, now we are. So when we actually sell the product, what we need to do is we need to expense it. We expense through cost of goods sold. So you're going to debit cost of goods sold. You no longer have that inventory in your wares because you sold it to your customer, which means you need to reduce that inventory account, and inventory accounts always go down on the credit side. So you're going to credit finished goods inventory, this time for the amount that you paid to produce it, which for Smart Touch Learning is $584,600. And through our T accounts here, we see that costs are getting transferred from WIP into finished goods at the time that they're completed, and then out of finished goods and into cost of goods sold when the job is actually sold. So the allocation method of overhead allows companies to record expenses at the time things are happening. But the problem is it's based upon a guess, and it's very hard to guess to the dollar what your actual overhead costs are going to be. It's very hard to guess to the dollar what your quantity of the driver is going to be. So in the case of the example we had, what their actual labor costs were going to be during the period. You do your best, but you're never correct. You're going to put a certain amount of cost for overhead into jobs, wait until the period ends, record your actuals, and then realize that you were off. Well, that requires you to fix your journal entries, because we have to expense our inventory at what it actually cost us. And if we made a bad guess, we could have too much cost in there, or we could have too little cost in there. And they call that the under or over allocation of overhead. If you don't put enough costs into the job as you are allocating out overhead, you have underallocated overhead. So that job cost record you have is actually too low for what it should be. There should be more cost in there. Vice versa, if you put too much cost in, well, now you're carrying the value of that inventory, or you're recording the expense for cost of goods sold. That's too much of a cost. It's a too high of a price. You have overallocated overhead to that particular piece of inventory. And to figure out how to fix this, you got to come up with some kind of methodology. And there's several different ways to do this. The easiest one is the write-off to COGS method. And that is all I want you guys to know for this period. So essentially what happens is, if your manufacturing overhead account is off, you just simply add that much to cost of goods sold if you underallocated, or subtract that much from cost of goods sold if you overallocated. How do you know how much? You look at your manufacturing overhead T. See, actual costs happen on the debit side. Move my cursor around over here. Allocated costs happen on the credit side. Well, we said this was going to cost $67,600 during the period. That we expected that to be our manufacturing overhead. We took that amount, we spread it out amongst jobs. And then when we have the actual costs come in for $83,000, well, we put too much cost. We didn't put enough cost, into those jobs to come up with the actual cost. So all of our inventory throughout the period is at too small of a balance because we grossly underestimated what our overhead costs were going to be. Our actual costs were $15,400 more than our allocated costs. Well, we got to find some way to fix that. And the way that we're going to fix it is we're just going to simply add that additional $15,400 to cost of goods sold. And if you look at the manufacturing overhead T account over here, that's how you always know what the number is. See, manufacturing overhead is what they call a transitional account. Its whole purpose in the accounting process is to get costs